Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Red Rock Resorts Inc. Annual Report. Red Rock Resorts Inc. offers a diverse range of businesses and services through its interest in Station Casinos LLC. The company's primary focus is on developing and managing casino and entertainment properties across the United States. Specifically, it owns and operates gaming and entertainment facilities, such as Durango Casino and Resort and smaller casinos within the Las Vegas regional market. These establishments provide various amenities and activities for patrons, including gaming options, dining experiences, and entertainment venues. By catering to a wide range of interests, Red Rock Resorts, Inc. aims to create an immersive experience for its customers, making it a prominent player in the hospitality and entertainment industry. The stock price of Red Rock Resorts, Inc. has seen a substantial increase of 32.48% in the past year, with its peak reaching $68.99. Several key news events have contributed to this rise. One major factor is the company's consistent reporting of strong quarterly earnings throughout 2025, surpassing analyst expectations and showing growth in key metrics. Red Rock Resorts' financial performance has been impressive, with notable increases in net revenues, net income, and adjusted EBITDA across all 4 quarters of 2025. The company also reported record Las Vegas revenue and exceeded EPS forecasts in several instances. This robust financial performance has instilled confidence in investors, driving up the stock price. In addition to its strong earnings reports, Red Rock Resorts' strategic expansion and development projects have also contributed to the increase in its stock price. The company's commitment to growth through property enhancements, such as the Durango Casino, and resort expansion and renovations at existing properties, has been well received by investors. Furthermore, the company's increased shareholder returns have played a significant role in driving up the stock price. Red Rock Resorts has consistently declared and paid quarterly cash dividends throughout 2025 and into 2026, and even announced a special dividend of $1 per share alongside its strong Q4 2025 earnings. The expansion of its share repurchase program by $300 million also signals management's confidence in the company's valuation. Overall, the combination of Red Rock Resorts' robust financial performance, strategic expansions, and increased shareholder returns has fueled the significant increase in its stock price over the past year. Red Rock Resorts, Inc. maintains a market capitalization of $7 billion, broadly in line with the industry peer group. Red Rock Resorts, Inc. trades at a higher price-to-earnings ratio of 21 times and a higher price-to-book ratio of 17.92 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company exhibits a very high leverage profile, with liabilities accounting for 92% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline for a business can be attributed to various factors. On one hand, revenue growth is driven by strong carded slot play, robust visitation and net theoretical win across most properties, favorable customer trends, population growth in the Las Vegas metropolitan area, low unemployment rate, and innovative marketing efforts. Additionally, providing a high-value entertainment experience with diverse gaming options, dining, and attentive guest service also contributes to revenue growth. Furthermore, targeted marketing and promotional programs, utilizing proprietary customer relationship management systems, and investing in technology such as on-device, marketing, bonusing, and guest communication can also drive revenue growth. On the other hand, revenue decline is driven by seasonality, competition from other casinos and hotels, restricted gaming locations, internet poker and sports betting operators, and Native American gaming facilities. Other factors that may impact revenue include tax benefits from exchanges of LLC units, depreciation and amortization deductions, and sufficient taxable income each year. These drivers can have a significant impact on the financial performance of a business, making it essential to understand and address them accordingly. Net income experienced a contradictory trend between 2024 and 2025. On one hand, it increased by $28.7 million from $568.7 million to $597.4 million in 2025 compared to the previous year. However, this increase was offset by a significant decrease of $64,378, or 22.1% year-over-year from 2024 to 2025. Furthermore, net income remained unchanged from 2024 to 2025, and even increased by $34,015 from 2023 to 2025. Profit margins also underwent changes during this period. Operating margin increased from 29.4% in 2024 to 29.7% in 2025, while net margin rose from 15% in 2024 to 17.7% in 2025. Additionally, adjusted EBITDA margin saw a notable increase of 4.3 percentage points compared to the previous year, resulting in a margin of 42.2% in 2025. The reasons behind these changes are multifaceted. Potential losses from inadequate insurance coverage and increased insurance costs were major concerns. Moreover, decreased availability of insurance coverage, potential penalties and fines for noncompliance with ESG regulations, and negative impacts on reputation, customer attraction and retention, access to capital, and employee recruitment and retention due to ESG practices and reporting also contributed to the fluctuations in net income and profit margins. Fluctuations in revenues and changes in working capital accounts further added to the complexity of these changes. The company's financial performance indicates a positive trend in its operating cash flow. According to the provided information, the net cash provided by operating activities for 2025 is a substantial $609,513,000. This figure is also reflected in the operating cash flow 2025 on page 61, which shows an identical amount of $609,513. While it may seem insignificant, the operating cash flows from operating leases in 2025 are actually a positive addition to the overall operating cash flow. With a value of $7,270, this contribution is minimal but still contributes to the company's overall positive operating cash flow. Overall, these figures suggest that the company is generating sufficient cash from its operations to support its financial obligations and investments. The company's debt level and interest expenses have undergone significant changes over the past year. Initially, the debt level increased from $3.43 billion in December 2025 to an unknown amount in 2024. However, subsequent reports reveal a decrease in total long-term debt by $28,979, indicating a reduction in overall debt. Regarding interest expenses, there is a notable decrease of 11.8% from $228.8 million in 2024 to $201.9 million in 2025. This trend is consistent across multiple reports, with slight variations in the exact figures. The decrease in interest expenses suggests that the company has managed to reduce its financial burden and optimize its debt obligations. Overall, while the initial report indicated an increase in debt level, subsequent updates reveal a reduction in total long-term debt. Additionally, the significant decrease in interest expenses highlights the company's efforts to minimize its financial costs. The performance of various segments within the company has been analyzed. Notably, two segments have shown strong results. The Las Vegas operations generated $1,981,782 in segment net revenues and $915,884 in segment adjusted EBITDA. Additionally, the Native American Management segment reported $17,632 in segment net revenues and $17,7 $632 in segment, adjusted EBITDA. On the other hand, there are segments that have underperformed. The corporate and other segment has been particularly weak, with a loss of -$84,925 in corporate and other adjusted EBITDA. This indicates areas where the company needs to focus on improvement to achieve better financial outcomes. Management is optimistic about the company's outlook, citing its unique offerings and competitive advantages. They believe their high-quality entertainment experience, new and popular slot games, and convenient locations set them apart from competitors. To drive growth and equity holder returns, management plans to pursue new opportunities, acquisitions, and development projects while utilizing a flexible capital structure. However, they also acknowledge potential challenges such as regulatory hurdles, economic downturns, and intensifying competition in the Las Vegas market. Management is concerned about the company's substantial debt, which imposes restrictive covenants limiting flexibility in operating the business. They are also aware of external risks associated with integrating AI technologies and uncertainty around project costs and timelines. Despite these challenges, management remains committed to providing a high-value entertainment experience for guests and expects sufficient cash on hand, operating cash flow, and borrowings to fund operations and capital requirements for the next 12 months. The company's long-term plan is to continue growing its gaming and entertainment facilities in the Las Vegas regional market. The company's financial activities have been transparent and consistent with its shareholder value creation strategy. One key aspect of this approach is the payment of dividends to shareholders. As per our records, the company has indeed paid dividends in the past, as detailed on page 38 under the dividends section. In addition to dividend payments, the company has also implemented a share buyback program. This initiative allows the company to repurchase its own shares from the market, thereby reducing the outstanding share count and potentially increasing earnings per share for existing shareholders. The details of this program can be found on page 38 under the share buyback section. Overall, these actions demonstrate the company's commitment to returning value to its shareholders through both dividend payments and strategic share buybacks. Supply chain disruption there are concerns about inventory buildup and supply chain disruption. The main issue lies in the shortage of essential materials and skilled labor. This problem is further exacerbated by external factors that are beyond one's control, such as unforeseen disruptions to the supply chain. These disruptions can have a ripple effect throughout the entire production process, leading to delays and inefficiencies. As a result, businesses must be prepared to adapt quickly to changing circumstances in order to minimize the impact of these disruptions on their operations. That concludes the financial summary for Red Rock Resorts, Inc. Feel free to comment below, and I will be happy to answer them when possible.